Hey guys, welcome to Picture Perfect Portfolios. I'm your host, Nomadic Samuel, and this video was not supposed to happen. I wasn't even planning on creating a YouTube channel just yet, but I had a fascinating discussion with someone I really admire, Meb Faber. We were actually going to be doing an interview. The idea was to record it, and then for me to just pull the script and make it as basically an article on my website. But I thought it was such an interesting discussion that I'd like to publish it as the very first video post on my YouTube channel. So there were a number of things that are a little bit strange about the podcast. I'm reading questions off of a second monitor, so it looks like I've got shifty eyes. And also I didn't properly introduce my guest. And so, I mean, where do you even start with Meb Faber? He's a quant legend in the investing industry. He runs Cambria funds. There's a fantastic roster of ETFs, really interesting multi-factor equity strategies, and a whole range of other products, including different asset allocation funds. So I've greatly benefited from the knowledge that Meb has shared generously on Twitter, on his blog, also on the Idea Farm, and of course on his really popular podcast, The Meb Faber Show. So you know what? This was not meant to happen, but we're gonna get it out there as it is. And I think you guys will really enjoy this subject. We covered a lot of different topics. The idea was for this interview to be based on the How I Invest series. And yeah, it's basically going to be just put out there as it is. So let's hop over and see what Meb has to say. And one last thing, I almost forgot. This is absolutely not investing advice. This is just a conversation between two gentlemen riffing on a number of subjects. So let's just hop into the interview. Who were your greatest influences as an investor when you first started to get passionate about the subject? Sorry, some of these are kind of like multifaceted, so maybe we can just focus on one part as opposed to the whole thing. So who are your greatest influences as an investor when you first started to get passionate about the subject? How have your views evolved over the years to where you currently stand? And if you could recommend any resources that people could check out, books, podcasts, white papers, to bring others up to speed with your investing worldview, what would you recommend? So I guess basically, yeah.
All right, so that's a three-part question. We'll do them one at a time.
Okay.
I'll start with the last one first, just because it's on my mind. You know, we talk a lot about the lack of personal finance education in the United States. We don't teach it in high school. We certainly don't teach it in middle or elementary school, and we should. That's getting better. So it used to be around 10% of high schools would teach it. Now it's drifting up to 30, 40%. It's still less than half. And that's unfortunate, because what does everyone use on a daily basis in a practical level more than anything? And that's money. And it doesn't have to be boring personal finance. It can be just this concept of freedom and wealth and budgeting. Anyway, so we've done a couple posts over the years, and I'll tell you about two. One was called The Number One Investing Book, which was, I reached out to all of my kind of contemporaries and friends, got over 1,000 responses, and I said, if you had to just gift someone one investing book to learn about investing, what would it be? And got back a gazillion answers, but I kind of narrowed it down to the top 10. So I'll send you that list. Second is I did it a little bit different. As I said, what if someone wants to go from, okay, instead of just learning how to, just one book, I actually want to learn the craft of investing. And that's another post. It's called Learning How to Invest. And this one, we voted on like 5 categories. And I'll tell you what they are. Personal finance, the winner was The Millionaire Next Door by Stanley. Stocks, the pick was The Little Book of Common Sense Investing by Bogle. Asset allocation, they picked my book, Global Asset Allocation, but since that's a biased poll, I said, what's a non-Meb book, which was The Intelligent Asset Allocator by Bernstein. For history and markets, they picked Fooled by Randomness by Taleb. And sort of an investing 2.0, you know, these are all intro. You want to get What Works on Wall Street by Jim O'Shaughnessy. Behavioral investing, Thinking Fast and Slow by Kahneman. And then the Old Market Wizards Profiles by Jack Schwager. that's a good tuition. Now, the good news is there may be people out there say, you know what, guys, I don't want to do this. I don't want to read all these books. What's to get anything easier? And we did we started curating back in 2017 the top investing podcasts. Now, some of these are wonky and some of them are not intro, but you could go to Spotify and do the Idea Farm playlist 2017, 18, 19, 20, 21, now into 22. So there's like, hundreds of hours of top content from, the world's greatest investors. So that'll get you started. And so, that's a good way to get going. Second question, who were some mentors? I was actually supposed to talk to one tonight. I've never met him because he's in Singapore, but we had to reschedule, I think. We'll see. Jim Rogers, his books, I think, were pretty influential when I was younger, maybe college age, investment biker, adventure capitalist, talking about traveling all over the world and not investing just within your own borders. Is a really formative book. And I think a lot, like when we mentioned the Schwager Market Wizards books, I think those had an impression that, there was lots of different personalities and styles, but more importantly, lots of different ways to make money in markets, and over time. And those were a pretty big influence as well. And I forgot the third question.
Oh, yeah, sorry. Yeah, let's go up here. Yeah, Jim was the guy who did the epic around the world trip, if I remember correctly.
A couple times, yeah, he's done it a few times.
And then with a like a custom made vehicle or something.
Yeah.
Yes,
custom made Mercedes.
No, I think that pretty much covers it. It was basically greatest influences. Maybe how have your views evolved over the years? Has anything shifted?
Oh, wow, that's a probably an hour-long conversation, but we can dive in. I think like many investors, particularly the younger set, the Robinhood crew, the past few years, like when you're really young, you're finding your footing. You're finding what works for you. Unless you're Warren Buffett, who said he was inoculated at a young age for value investing, a lot of people, it's trial and error. They go through experiences, they touch the stove a few times, they learn what fits them and what not to do. And I think that was true for my experience and most. And so for me, I really struggled or did not enjoy the discretionary subjective investing process. I gravitated at an early age towards, early age meaning my 20s, my career early age, not early age, towards rules-based, objective, quantitative strategies. Now, that doesn't mean it has to be complicated. It could be very simple. 50-50 stocks, bonds, rebalance once a year. That's rules-based and quantitative, So, but for me, I tweeted about this the other day, and I said, discretionary to me is a total nightmare. I would go crazy emotionally, psychologically, everything, trying to figure out, with all the news flow and markets and everything else. So, I think as far as what's changed for me, probably in the last decade, I think there's been a couple. The big one, which you've probably heard me say before, is, when there's a tweet I retweeted the other day from Kenneth French, one of the most famous professors in finance. His data set, which is free online for the people that want to play around at the Fama French, Fama being the Nobel laureate, Eugene Fama. But he had a tweet the other day. He's like, basically, and I'm summarizing, he's like, it's insane for people to try to draw conclusions from 3, 5, even 10 years of asset class or active strategy returns. Meaning, if you're looking at the short run of how investments perform, that's foolish. Now, what do most people look at? Normally, I would have said 1 to 2 or 3 years, You know, in this modern age, it's, you know, 1 to 3 months maybe, which is nuts. And so I actually think my time horizon is kind of spread out to even more than 10 years now, which really, I think, aligns with almost zero, you know, actual behaviors of people, institutions, as well as individuals. So that's a big one. I think you need to look at much longer time horizons. People don't like to hear that. You know, they want certainty. They want it now. You know, I also think this is obvious, and it's not a unique insight. People have been talking about this certainly for 50 plus years, but I think it's a critical insight, and one that gets overlooked, which is, you know, costs matter, and costs are not just expense ratio. You know, it's everything involved with an investment, a strategy, including taxes, which people hate paying, but I think don't necessarily optimize as much as they should be. So those are two big ones. Long time horizon, the impact of low cost. Now, the good news is there's never been a better time in history to be an investor, right? So, you know, the ability to invest globally for near zero cost, but it's also never been a time in history that's been as easy to light your money on fire too. So the casino is always open, which makes it makes it hard.
Oh, for sure. Actually, one of the things when I was doing the ETF review of your GAA fund was I was so impressed by, well, first off, it avoids all the expensive high PE stocks. Then all of the funds that you had in there, like your shareholder funds, I mean, they were having incredible multi-factor exposure, value, yield, some of them momentum, I remember. And then the other thing that was impressive was just you put some thought into the fixed income sleeve. That a lot of times you just see investors maybe grabbing the long-term treasury, the 10-year, and then they're done. That's it. That's their only bond allocation. Whereas you had like emerging markets, like high yield, aggregate. You had like just completely covered all the bases. That was really, really impressive.
The one of the things, you know, we have 12 funds, over 125,000 investors now, which is crazy to think about. But you know, when we launch funds in a world of 10,000 plus funds out there, why does the world need any more funds, right? Like, how has the investment landscape not been totally wallpapered over 10 times? And we said, you know, we try to launch funds that don't exist, which is, people are like, wow, there's things that don't exist. And yeah, there's actually quite a few ideas that we have that don't, doesn't mean they're good ideas, just mean they don't exist. Or we think we could do it better or cheaper. And so in the fund you just mentioned, Case, you know, we said, look, by definition, buy and hold, you don't do anything. You buy and hold, literally. And so I said, you know, why isn't there a low cost asset allocation ETF? You know, this asset allocation category, despite fees coming down both in the US and globally, is still really high cost, which to me was crazy. So I said, you know what? And at the time we launched this, it was the first ETF that had no management fees. So we charge nothing on it. Now it's fund of funds. So the underlying fund basket, it owns funds, some of which are ours. But our goal is to just break even on this fund. I don't care if we ever make money. And I'm trying to think of a nice way to say it, but we basically wanted it to be a giant middle finger to the entire industry and say, hey, look, we're going to do this for free. Can you beat this? Probably not. And so the good news is the fund's done, we believe, great performance. But there's some interesting kind of hidden pieces of information that the average investor may miss. And one that we talk a lot about, obviously the ETF structure is tax efficient. And by the way, sorry, for listeners, this fund is meant to be a global asset allocation if you just went out and bought the world of public assets. So it's global stocks, global bonds, and global real assets like real estate, commodities, tips, things like that. And then it has tilts towards value and momentum, which we could probably get into too. But the point of this fund, so it's low cost, but in addition, there's a hidden yield we talk about for public funds often, not always, but we do it, and most of the good guys do, is that you can lend securities. It's called securities lending. It's a very time-honored, basic, simple sort of strategy where it could add, in this case, usually 0.1 to 0.2% per year in income and returns. And you say, oh, well, that's not that significant. Well, it is that significant when you consider, that these funds are low cost already. Now, on some funds, we have one fund that had over 1 or 2 percentage points of return from the short lending a year ago. And this kind of goes through waves, in and out. Sometimes it's higher, sometimes it's lower. So you can't claim a specific yield. But a lot of places keep it. Robinhood, for example, famously will lend your securities out and then keeps all the revenue. And we call them out on it. And then finally, they did a huge press release this fall or this summer. Huge press release. Hey, we're doing security lending. We're sharing it with customers. We're such good guys. And then you read the fine print and they're still keeping 85%. So you're like, okay, well, so that's really just PR, because we return all of it. We don't keep a single cent, right? And so there's like a little bit, maybe 10, 20% that's used to pay for just the corporate finance. We don't ever touch any of that. It goes to our admin. Anyway, but it's an interesting idea, because there are funds out there now that essentially have a negative expense ratio, meaning they pay you to own those funds. And that's cool. And I don't think a lot of investors appreciate or understand that reality. But we're pretty outspoken on it. And we have a piece on our Cambria Funds website called Securities Lending. If you want to dive in, it's a little wonky and esoteric, but it gets deeper into the topic.
Well, that's fantastic. I mean, for a fund, when I think of the typical asset allocation funds, they're so incredibly vanilla. It's just large cap centric, usually home bias, which you've talked about a lot before. That's one of the topics that I remember when I was just listening to you on various podcasts. I remember you would discuss, not just as a US investor, but if you were based in Turkey or Russia or any country in particular, you might own 90% of your home country equities, which at least in the US, you're kind of covering half. You're reasonably proportioned. But if you were in Sweden, maybe the economy there is 1 to 3% of the global equity market, and you may have 90% equities.
Yeah, you're talking about a concept of, in 2022, investing globally should be the table stakes base case where you begin, right? And if you want to be concentrated or invest more in a certain region, go ahead. If you wanted to market cap weight the world, sure, that's roughly half US, and then it goes down the line from countries from there. And you end up with tens of thousands of stocks, right? And that's an awesome portfolio. And historically, that does great. Let's call it 8, 9, 10% a year. After inflation, it's usually down around 5. Awesome way to invest over time. Diversified globally is lower risk, lower volatility, and drawdowns. But so then why do people just invest in their own country or region? And we call this home country bias. We talk a lot about it, and it happens everywhere. It's our Japanese friends invest most in Japan. Same for our Chinese and Russian and Greek and Spanish and Colombian, Argentine, on and on. And people do it for a number of reasons. I think part of it is it's a false sense of security. They feel like they invest in what they know. And there's a whole host of other reasons. But we often tell people, we say, well, why not start with the inversion? People always say, Meb, why should I invest in foreign stocks? I say, let's start with the opposite. Why should you invest in US stocks? Why not just invest all in foreign stocks? And no one, of course, does that. But historically, it makes very little difference where the stocks are based. So we often tell people, and we did a tweet about this that you probably saw, where we said, look, swapping out, and you could, from a US-based investor, own theoretically no US stocks. And how does that change performance? And it makes very little impact to a global portfolio. And that surprises people. And so we say, what is a much more important portfolio? It's not where the stocks are, it's what the stocks are. So if you move away from these market cap weighted indices to things like value, so like a Warren Buffett style, you invest in stocks that have good cash flows, that are cheap, that treat shareholders well through dividends and buybacks. They're not super leveraged. They're high quality businesses. surprise, surprise, that's a much better concept than just focusing on borders. This is our shareholder yield idea. We have 3 funds that do this: U.S., foreign, and emerging. They've all performed great, we think. And more importantly, we think they have their best days ahead of them because the value spread, a lot of people talk about this publicly, between cheap and expensive, and then particularly expensive US, and then cheap US and cheap foreign is really wide. So I think very similar to 2000, 2003 period, which is where I cut my teeth, is right out of university, right into a vicious bear market. I think you'll see probably a similar analog going forward. And you've had a couple nice years of value performance already, 2021 and 2022. But my opinion, and again, I'm a quant, so it really doesn't matter what my opinion is. But I think this value trade has some room to run.
Oh yeah, I couldn't agree with you more. I mean, like the spreads they seem to be close to all-time highs. And then on top of that, you have the emerging markets and international developed markets having relatively underperformed versus US stocks for over a decade now. People forget the 2000s, of course, when there was a lost decade for the US large caps. But now you have, like, especially if I had to pick one dart to throw for the next little while, it'd probably be emerging markets, something similar to the fund that you have, very low PE, lots of multi-factor exposure. That could absolutely rip for the next decade.
Yeah. I mean, like anything, and I think this year is a good example, investing styles and strategies go through seasons. This year, the example I'm giving is that traditional investment stocks and bonds are down, and an asset class that has been maligned for a long time, is, at least through August, is having a much better year, which is being commodities and the energy complex, partially due to this return of inflation. And so you had a period where these growth stocks, we have a Twitter thread called What in Tarnation, and it was a summary of just crazy things going on in markets back in February of 2021, which was kind of the crescendo of the nonsense. And looking back on that, you just realize markets, have seasons. There's times when value looks really stupid, which has to sort of be the case. Otherwise, everyone would do it, and the value premium would probably never be there. But there has to be times when the growth expectations go to the moon, and everyone is expecting that world to extrapolate forever. Well, that's probably the time you should get your wits about you and transition to value. So, but we, at least historically speaking, think it certainly has a way to go from here.
Yeah, absolutely. All right, I guess I'll jump back into the interview. So let me see. So you kind of sort of touched upon this already, like who your influences, but the next one was, aside from investing influences, what real life events have molded your overall views as an investor? Was it something to do with the way you grew up, taking on too much risk or not enough early on in your investing journey, or just any other life events or personality traits, characteristics, education, travel, work experience? Like, just briefly for me, I grew up in a resource town on Vancouver Island, was one of the highest per capita income small towns in Canada. And then in the 90s, it completely lost both of its industry sources, the pulp and paper mill. The devastation that caused was like, it's hard to even quantify. It's like there's people, it caused divorce, suicide, relocation. For some people, they landed on their feet, started new businesses or whatever. It was a nice pivot. But for other people, it was sort of like the start of a serious downfall. And because this was kind of simultaneously going on in a lot of communities all at once, there was a lot of people whose their jobs, they weren't really trained to do much else, and they had a really hard time pivoting in their 40s, 50s, for example. So, I mean, for me, that's made me a little more sensitive to risk than maybe an average investor. Like, I really like to spread out my portfolio, between equities, bonds, and especially alternatives. Probably have more alternatives in my portfolio than just about anyone else on the planet. But I love to have as many uncorrelated asset classes as possible. And I like to use a bit of leverage so I don't have to compromise on the returns. That's just
I mean, I think you hit on a key point that every investor needs to be honest about, and most, I think, are not. They actually do the exact opposite of what they should do, which is think about your human capital and how that relates to your portfolio. And for example, we could look back and we say, okay, let's say you're in the energy industry and you live in Texas, which is already, everything in Texas is correlated to what's going on in the energy world. So housing and the economy, everything, employment. And let's say you worked at a company called Enron and then invest all of your 401k or retirement into Enron stock, right? And now in retrospect, you say, wow, what a dumb idea. Why would anyone do that? But many people do. And so there's even when we're talking back about the home country bias, you go ask someone around the world currently in Russia, China, Greece, Brazil, was it a good idea to invest all of your money in stocks of your own country? And they would say, hell no, right? Like that was so dumb. But then you look at people within the US, the people in Texas invest most of their portfolio in a big overweight to energy. People in California, big overweight to tech. People in the Northeast, a big overweight to financials. Like, you can't make it up. Like, why are you doing that? That's crazy. You should do the exact opposite. And so we talk a lot about financial advisors, and we wrote a piece that I think no one read the appendix, but we talked about financial advisors are 4 times leveraged the stock market, and they don't necessarily know it, or they don't act on it. So they own stocks in their own portfolio. They own stocks in client portfolios, which their revenue is tied to. When stocks go down, clients leave, and then companies even downsize if you don't own your own company. So there's like all these reasons you could argue, not only should you not own any US stocks, but you should be short US stocks. Now, no one does that, of course. This is one of I have currently 18 opinions on Twitter where I say, this is something I believe the vast majority of my professional peers don't believe. And I need 2 more to get to a nice round 20. But I'm at 18 right now. But there's a lot on there that, some of the beliefs that we have don't really correlate to what others believe. And this is one of the problems, of course, with buy and hold investing. Buy and hold investing often, traditionally, is highly correlated to what's going on in the real economy. So when does buy and hold suffer? Think back 2000, 2003, 2008, COVID. When everything's hitting the fan, your portfolio is also going down. So you're saying, well, that's not actually what I really want, right? Like, I actually would probably want more money when it's hitting the fan and less when times are good, right? Because when times are good, I'll be getting raises or doing more business with my company or sales. Like, you want that to be offsetting. And so you reference things like alternatives. This year is a good example. It's one of the worst years ever for a traditional US stocks and bonds portfolio. People expect them to diversify. They shouldn't. If you're a student of history, sometimes bonds help, sometimes they don't. And I would argue it's actually been a great year because bonds have now reset up to 3 and change yield. So if you do have the further downdraft in stocks where they go down 30, 60, whatever, the bond yields will actually probably help going forward. I think we'll see. But at least to date, my guess is 90% of investors are down this year.
Yeah.
We did a poll on Twitter, and most said that, then that was in line with what, my guess is, but 90% of funds are down. So it's not a surprise to me.
I mean, like, for the people that have something that's up this year, they would have one heck of a different portfolio than the crowd. I mean, you would probably have a lot allocated to trend following. You would have maybe some long short equities, multi-factor minus junk. That's been a pretty good trade this year. You would have especially if you're shorting the like some of the overpriced growth stocks. Market neutral's been up for some funds. Like I'm trying to think of which things I own that have been up. Those have been the things that have been up. I've had a couple absolute return bond funds do okay, but you know, by and large though, right, it has been a slaughter. And for some of the funds that I have that are of configurations that stretch the canvas beyond 100%, they've been getting, you know, obliterated, the 90-60 funds, ones like that. And it's kind of, they've really shown their Achilles heel this year. But I'm definitely of the opinion, because if you take a look at something like that over a 40 or 50 year period, this year is very strange in the sense that equities, bonds, and gold have been down. I wrote an article on my site. I was looking at how often has it happened when the U.S. stock market, the 10-year Treasury, and gold has been down? This year, in the past 50 years, that's the only time. I couldn't believe it.
A lot of it's harder with gold in the early part of the 20th century because it wasn't really freely trading, but bonds, the first half of the 20th century, acted a little different than they have since then. You know, the decades that this feels most similar to me right now is the 70s and the 40s. And inflation, you know, we talk about long-term time horizons earlier in the show, and I said 3, 5, 10 years. Well, most people managing money today weren't managing money in the 70s, right? So, because you would have been, you know, even if you were in your 20s at the time, like you're now 70 years old, you're probably retired and you know, screaming at the Reddit Robin Hooders, you know, you crazy kids. But for the first time in a long time, we have a different macro backdrop than we've had for the past 40 years, which is kind of one of the interesting things about markets. Like, you often will have these things where people go, oh my God, that's a black swan, it's surprising me. We say, well, no, it's just surprising because no one around now has been through this. 2008 was similar because that was very similar to a 1930s style market where kind of everything went down, you know, at the same time, with the exception of bonds. So that's what markets do, right? They have a way of surprising people just because people weren't around. But I think it's been so long since value and trend is another one, certainly, that's having a great year. Managed futures and trend following funds are having a moment, but they've been going nowhere for the better part of a decade. So most people, many had given up on them.
Yeah, I remember just some personal experiences. That's right. In terms of inflation, there would be people that have had no experience with that as an investor. I've had a little bit more as a traveler. My wife is Canadian, but her father's from Argentina. So we've gone to Argentina many times. And to see what happens down there, they'll have a menu at a restaurant, and then they'll have stickers over the price because it's changing so often. I remember there was one time when we were based in Buenos Aires for a month. I went for a jog, and then I had memorized the price where I could go and grab a couple slices of pizza and a beer. It was a lunch special. It was like 65 pesos. And I just had that exact amount in my pocket. I go to the place and now it's like 85 or 90. I'm like, I gotta go back to my apartment before I go have lunch. I mean, and then another example of that, we're working on a hotel project in Argentina at the moment. It's a family property that's been kind of neglected for a while. We paid a local worker in US dollars about 2 months ago to continue some landscaping work while we're back in Canada. Since then, the exchange rate has gone from one US dollar to 200 pesos on the blue market, and now it's ballooned up to 300. So good for him. He has something. He has a currency that's stable. But down there, it's just the inflation in other parts of the world. I think Turkey is another example of that. We've been quite lucky in the developed world to have had very reasonable inflation for a long time. But this has been probably the first experience for some younger investors to have ever had any inflation to think about, not just investing, but I guess in life in general. They've probably had to reconsider some purchases, and used cars have really gone up, things like that.
Yeah. No, I mean, inflation is a topic that is a classic example of no one pays attention to it till it shows up, and then it starts to materially change behavior. We'll see. You know, we the hope is it comes back down, but in the U.S., but and most developed economies. But we did a podcast recently where they thought it may be higher for longer. And it's kind of that time under the curve, right? If it goes up and right back down, not a big deal. If it goes up and spends some time at 4, 5, 6, 7, 8, 9%, then that's what really starts to alter behavior. And the biggest problem with inflation, you know, you have to own things. If you got cash, and by cash I mean under the mattress, you know, and inflation 7, like you're losing significant purchasing power. So you got to own stuff. Reminds me, you mentioned that when I was down in Argentina, I saw like more yachts in the marina, I think, than I ever seen. And I said, why are there so many giant yachts? My God. And they said, well, Meb, because it's better to own a depreciating boat, which is a horrible investment, than a depreciating cash, which is going to be worse. Like at least you got to own something. Right?
Yeah, exactly. It's so relative down there. Some of their real assets retain more value than they would in the States or Canada, for instance. Like some of the vehicles that people buy don't depreciate as much as they would over here, and there's just less of that kind of turnover. As consumers, you'll buy a vehicle down there, they'll view it as a 10, 20-year investment, and you see some really interesting vehicles on the road. You know, stuff from like like a truck from the 70s or something. You're just like, wow, it's kind of fascinating to see how much mileage they've got out of it. Yeah, for sure. Okay, let me go to the next one here. Okay, so this part is the more of like this series is actually called the How I Invest. So we're moving into that segment now. So the question exactly is, let's pop open the hood of your portfolio. What kind of goodies do we have inside? Spill the beans. How much you got of this? Why did you decide to add a bit of that? So that you could go over the line items or just kind of go over categories or quadrants. When do you anticipate your portfolio performing at its best and at its worst?
Yeah, so I'm sort of the rare portfolio manager professional that discloses my portfolio, and I've been doing it kind of for some number of years. And it's I did the last one, I think, on a blog post during COVID. No, I actually updated this past year, called How I Invest. And so you know, I kind of walk through less for investors just voyeuring into like specific stock picks, and more just kind of the framework for how I think about the world and investing. You know, so I'm mid-40s, have a family, talk about, you know, my entrepreneurial businesses and how I bucket those sort of impacts on my net worth, which is probably, you know, depending on what you consider the value, between 50 and 99% of my net worth. But then talking about the portfolio, and for me, I like to kind of bucket into kind of the get rich portfolio, you know, things that are hopefully going to appreciate a lot, and then also the stay rich portfolio. And the get rich portfolio for me over the past decade has been angel investing. I've invested in over 300 companies, you know, and detailed that adventure in a post called Journey to 100x, which is a lot of fun. I think for most people, I think 90% feel like it's inaccessible, startup investing, but I think that's not true in 2022, and it's certainly not necessarily inaccessible if you don't have a lot of money. I think you could invest with a lot smaller amounts, and I got started with very little amounts, and as a quant, a lot of shots on goal is what I want. And so that's one fun topic. We could spend an entire hour on that, you know. And then another is what is like my desert island public portfolio. And so for me, it's something we call Trinity, which is roughly half buy and hold. So a global asset allocation where half is value with half global allocation, of that allocation, roughly half is stocks, half is bonds. It's all global, and then a sprinkling of real assets in there, similar to the GAA fund we talked about earlier. The other half is trend, and we haven't spent that much time on trend yet. But trend, this concept, you're trying to be invested in markets going up and out, or short markets going down. Easier said than done. But trend often can look just like buy and hold. And for many years, it has over the past number of years. And then at other times, like right now, it looks nothing like buy and hold. So we do it where we go, instead of shorting, we'll go flat in one of our funds. But that fund is almost entirely invested in out of traditional markets, and it's got a handful of investments in natural resources, and that's it. That is not an inspiring risk-on portfolio for the average investor. The good thing about those two is they tend to yin and yang. Good examples, 2020 and this year as well. But walking through 2020 COVID, the first quarter of the year felt like markets were going straight to zero, right? The pandemic, everything going on. And you said, okay, well, the trend following really helped because that de-risked quick, and it got to an exposure that was mostly cash and bonds. And buy and hold struggled. And then on the flip side, as markets romped right back up to all-time highs on US stocks, you said, oh, goodness, thanks for buy and hold, because I probably would have just sat in cash forever. And the trend following was slower to respond. So you have this nice balance. That strategy is having a great relative year this year, partially because of the value trade, partially because of commodities, partially because of the trend. But all three of those, the trend really is impactful, not as much on these sort of 5 to 10% jiggles, but really on the after minus 20. So minus 30, 40, 50, 60, 70, 80, 90. That's when trend really kind of kicks in and saves your bacon. That's rare, right? It doesn't happen that much, but it does happen, and it happens enough for it to matter. So, and we don't know when it's going to happen, right? 2008 certainly happened, and there's been like 3 periods on US stocks where they've kind of rolled over and gone right back to new all-time highs in the last decade. Will that happen this time, or is there further downside? Nobody knows. I would certainly not bet on the former, and most of our models are pointing currently towards the latter. So we'll see, but they're currently saying it's probably not a good time to be taking on a lot of risk.
Yeah, I mean, you look at the U.S., the stock market, and it's still relatively expensive compared to the world. When you start isolating it versus international developed and emerging markets, it's like the PE has come down to something a bit more reasonable in the large caps, but it's not cheap, that's for sure. And unless you're kind of maybe mining the small cap or micro cap territory, it's looking awfully expensive still. Yeah. I mean, U.S. stocks historically traded long-term PE ratios around 18. In low inflationary environments, it's around 22. But in history, they've traded as low as 5 and as high as 45 before. And we're around 30 now. Now, the problem becomes is if inflation is sustained, the average PE is not 18 to 22, it's about 12. So, and people think that sounds hyperbolic and that I sound like a perma bear, but you got to remember my largest fund is a long only U.S. equity fund. Nothing benefits me more than U.S. equities going up forever. But just historically speaking, the downside to get back to average, not the downside to get back down to downside, but average is about a third to 50% from here, not from the highs. So you have to at least, with some tiny part of your brain, could be microscopic, accept that that's a possibility. And I think most people just ignore that as improbable. Improbable means impossible. And that's where people get into, I think, a lot of trouble. Yeah, for people that have that kind of overconfidence, it would be a good idea to see what happened to Japan in the 90s with their equities. It just would it took them like 3 decades to recover, basically.
Yeah. I mean, the yen seems to be falling out of bed now. So the good news is, post COVID, if you always wanted to travel to Japan, it's a lot better time with U.S. dollar, King dollar, kind of romping and stomping for the Americans on here. By the way, I've been reading a lot about seeing it in the media everywhere for Tofino. That's like the cool surf spot to go to on Vancouver Island now. Is that
Oh yeah, that's that sure it sure is. There's a lot of people that love to go there. It's closer to Victoria, so it's really interesting. The place I grew up in is closer to Tofino than it is to just about anywhere else, but it's inaccessible because there's no roads in the mountain range. So that part of the island is my favorite part, the west part of the island, that just you get access to the Pacific Ocean, and especially down there, there's a little bit more sunshine than other parts of the island. I grew up in a part that was notorious for excess rainfall, so there's definitely a nicer part of Vancouver Island. But there's
good. You can be my tour guide when I head up there.
Oh, I'd love to. I haven't been. I went back for the first time. My parents ended up leaving in the early 2000s, and I went back for the first time with my wife. We had a work project there for 2 weeks, and we absolutely loved it. We actually ended up doing some touristy things that I didn't do when I lived there.
That's always the case, right? Whenever you're in your hometown, you never do.
Oh, you never do anything. I have the perfect example of that. I went to university in Edmonton. I go to West Edmonton Mall, which was an attraction in Canada, the biggest mall in the country. I think it was the biggest mall in the world for a while. You go in there and they have this fantastic water park, and I'm like, oh, I've got to go and check that out. And then I ended up living there for 5.5 years. I never ended up going there. So it's always like you put it off and then you just never do it. Yeah, that's definitely how it is. All right, so the next one would be, what kind of investing skills, trading, asset allocation, investor psychology, etc., are necessary to become good at the style of investing you're pursuing? Is there a certain type of knowledge, experience, and or personality trait that gives one an advantage running this type of portfolio?
Yeah, I mean, I think there's two. I think one is curiosity. You know, for most of the strategies we talk about, the biggest personality trait is willingness not to muck around with the portfolio once you set it up. And so to do that, you need to have an appreciation for history. Most people skip the appreciation for history part, so they get surprised when things happen. So a good example is we do tweet polls all the time. We did a tweet poll on, you know, what's the most a traditional 60-40 portfolio has ever declined? And most people think it's like 10%. The answer is over 50, right? And so what happens is, if you don't know your history and you have a 60-40 and you think it's a quote moderate or conservative portfolio, and then it goes down 20 and you freak out, that's the problem. Like, it's not that your portfolio was poorly designed. It's not that you didn't set it up the right way. It's that you didn't really understand what could happen. Now, you go down 20%, it doesn't mean that, you know, it's any less painful if you're aware of it. It's still painful, but at least you know that it was possible. And we say that, you know, the vast majority of investors don't have a written investing plan, and they should, same way you might want to for a diet or exercise plan. And that way you can kind of keep yourself honest, or at least have a framework and foundation to which to compare it to. Because if you don't, you're just flying by the seat of your pants. And same thing, we poll everyone and say, do you establish sell criteria when you buy an investment? And everyone says no. And the problem with that, of course, is, well, you become emotionally attached to something as soon as you buy it. Doesn't matter if it's a coffee cup, you know, an old used car, or stock. Like your physiological relationship to that object changes. And so if you don't establish why you're going to sell something, and this doesn't just apply to the bad times, right? Like, you buy an investment, it goes down 10, 20%, 30%. Do you add more? Do you sell it? What's your plan? But also for the upside, you know, you buy an investment and it doubles. What are you going to do? You buy an investment and it goes up 10x, right? 10 times your money, which these happen, these 10, 50, 100 bagger investments, right? What are you going to do? It becomes a bigger and bigger part of your portfolio. Let's say you hit the lottery, you invest in 100 bagger, right? Do you trim some? Do do nothing in hopes that it becomes 1,000 bagger, life-changing wealth. And, you know, I think these are movies that you should think about ahead of time to play through, because once you're in it, you know, and a good example certainly is crypto, because that's, you know, it's just literally just a number going up and down for most people. And so they've been through the emotional roller coaster the past few years on how they think about these emotions of greed and fear and shame, envy. You know, it's harder than most would think ahead of time. So writing it down, working through it, trying not to be too judgmental about yourself as well. I think a lot of people beat themselves up about what happens after the fact, but it'll be useful to, you know, go through those experiences ahead of time.
Yeah, those are great points. Something that really surprises me is that a lot of investors don't know or anticipate the types of down or bear years that are going to happen. Like for a decade, you could have 2 to 4 negative years, possibly more. Maybe a brutal bear market once every 7 years on average. I believe that's sort of around roughly is what it's been historically. Sometimes worse. You look at the 2000s or the 70s, and you may be spending most of the decade in tough situations, especially for equities, and just sort of having that knowledge base and anticipating and expecting, and then also to design a portfolio that is appropriate. Like you were saying, a lot of people think that bonds are always there to save you, and they're not. There's people in our industry that actually consider equities and bonds to be offensive, in the offensive category, and then trend following, option strategies, and other things as defensive assets. So
yeah,
having something that's constructed, that's realistic, and just also having realistic expectations, not thinking that, you know, every year you're going to be going up, kind of anticipating that you're going to have down years. Even if you have construct the most all season portfolio on the planet, there's probably going to be a year, maybe something like 2018, when nothing's conspiring in your favor. And there's not much you can do about it. Just, you have to be able to like ride through the storm, I suppose.
Yeah,
exactly. So let me think. There's probably one or two.
I gotta hop in about 5 minutes. So
awesome. So what should we
choose your favorites?
I'll choose my favorite at this point. So, I think this will be perfect to end it off. How about, what's something that you believe as an investor, because you were saying that there are 18 of them, what's something you believe as an investor that is not widely agreed upon by the investing community at large? And I thought that'd probably be a great place to finish off.
There's a lot. You know, I think the one that we mentioned at the beginning, just because it's topical, I think, for many investors, and they don't believe it, is you could construct a portfolio that owns 0 US stocks and do just fine. And by just fine, meaning you do the difference between owning a global portfolio, so 60-40, with US stocks and without, it's like 0.3% per year difference. So meaningless. And that's with the hindsight bias that US stocks have outperformed everything else. And there were periods, so since the 50s, it's like no difference. And then there's other periods where it's like a 1% difference. But in general, it's not something that's going to drive your return. So if that's true, you should invest globally, because it reduces your outlier outcomes, good and bad. But again, to me, that's not the right question. The right question is not where are the stocks, because today you have stocks located in the UK, but they have all their sales in South America, or you have a company that's in a US index, doesn't even have US sales. And the average company, everyone's like, Meb, you don't understand, US companies get X amount of their sales from abroad. And I say, well, the US as a country, that's the lowest of all the developed markets. Most developed markets actually have a higher percentage of sales abroad than the US does. So everything is intertwined, globalization. And so the domicile is increasingly meaningless, as are sectors, I think. So I think it's not where, but what. And what really matters right now, where, well, people have learned that over the past year, because we said about a year ago, I said there's going to be this time when people are going to look around and say, when did all these stocks go down 40, 60, 90%? And a lot of the, the tech super expensive charts where, these companies were trading for 10, 50, 100 times revenues. Historically, that's an awful way to invest. Absolutely atrocious way to invest is buying expensive stocks. And that's always been true. But there's times when it's not true for a year or two and they go crazy. Well, a lot of those are down almost, unrecoverable amounts. But to me, the value trade hasn't even concluded yet. So it feels like. So anyway, have a global approach, go anywhere, and certainly think about investing in, it's like Warren Buffett 101, quality companies trading at cheap valuations with a lot of cash flows and treat their shareholders well. How can you go wrong with that? But look anywhere. And so a lot of the foreign markets, and particularly emerging, are really cheap. That's the good news. Yeah, I love ending on a positive note. Foreign and emerging are a lot cheaper than the U.S.
That's a fantastic positive note to end. And yeah, just thanks so much for taking your time to do this. You've really influenced me with your work, and I love your podcast. I love your writing, the free books you produce. Also, you have some fantastic funds that I think will really help investors out. So
cool,
yeah,
man. Well, look, come say hi in Los Angeles. I'd love to hang in the real world.
That would be awesome.
Around for a little more, but Mom is heading back to Colorado now, so I gotta hop.
Well, wishing a great trip, and yeah, take care.
All right, bud. Cheers.
Bye.